So you have the Paidoff Loan product, or maybe you're in the process of getting this amazing product. What if I were to tell you that there are a few simple things you can do immediately that will accelerate the payoff even faster? Well, there is, and it's what I like to call turbocharging the loan process. You see, keeping your loan balance as low as possible before the 21st of each month is the name of the game. Why? Because it's all about reducing your principal first, keeping your loan balance as low as possible, and then paying the least amount of interest each month. In order to do this, you need to put all of your income towards the loan balance and avoid making payments for things like bills, living expenses, entertainment, etc., using money out of your home equity line of credit, otherwise known as a HELOC. Before I tell you about these simple tricks, let's recap Paidoff for those who may be new to the loan product. 1. You're swapping out your traditional mortgage for a HELOC that is tied directly to your checking account. Number 2, all your income is swept from your checking account nightly to pay your HELOC balance down with every available dollar. This pays your loan balance down much faster and saves you a ton of interest. 3, if you need access to these funds for bills and living expenses, it comes directly out of your checking account and simply increases your HELOC balance. Think of this as loaning yourself money. Essentially, you become your own bank. And 4, interest is calculated daily based on your outstanding HELOC balance, and on the 21st of each month, all the daily interest is tallied for your overall interest payment. So the key takeaway here is that you will pay off your loan the fastest and cheapest by not spending money out of your HELOC, because the lower the balance, the less amount of interest you pay. Knowing how Paidoff works, there are a few things you can do that will turbocharge this loan paydown process, saving you a lot of time and interest on your home loan. Number 1, get a credit card and pay as many of your expenses as you can on that credit card. Why? Because it means you aren't paying bills from your checking account, which means you aren't increasing your HELOC balance. We all know that a larger balance means a larger interest payment. Number 2, make sure that credit card will also earn you rewards, whether it be airline points, cashback, or gift cards. You have to pay your bills anyway, so you may as well get paid for it, right? Number 3, I like to use a cashback card that automatically credits my account each month. This way, I don't have to think about it, and my credit card bill is slightly lower, saving me more money on my HELOC. My $200 to $300 credit each month really adds up over a year. In fact, it's a whopping $2,400 to $3,600 a year. It's like giving myself a raise. Lastly, call your billing companies and credit card companies and get your payment dates shifted to the end of the month. By doing this, you are almost guaranteed to have the lowest possible HELOC balance on the 21st when your interest is calculated. This is because you're using your credit card to pay your bills and you're deferring those payments until the end of the month after your interest has been calculated. Let's take a look at how this works. Across the top, I have a HELOC balance. On the bottom, I have a credit card line. That line is meant to show that I'm using a credit card to buy things like gas, pay bills, the grocery store, etc. So you see on April 30th, I have a HELOC balance of $200,000. On May 1st, I get my paycheck, which drops my balance of the HELOC by $5,000. Then I get paid again on May 15th, and it drops another $5,000. So my HELOC is now at $190,000. I haven't paid any bills out of the HELOC. I haven't written any checks, used the debit card, nothing. So on May 21st, when the interest is calculated, it's going to be on that $190,000, which is the absolute lowest value of the loan. I use 8% in this example, therefore the interest payment is about $1,250. Now, at the end of the month, that credit card payment is going to be due, and if you tally it up, it's $2,150. So when you add the $2,150 to the $1,250, the HELOC balance goes up to $193,400. From here, the process just repeats over again. You continue to use your credit card, and you do not make any payments out of the HELOC. Another way to visualize this is shown here. You're essentially stair-stepping your loan balance down in really large chunks. Then on the 21st, you have this small bump up with the interest payment, and then a slightly larger bump up with a credit card payment. But then again, your next paycheck comes in, and really stair steps the loan balance down again. Using this method, you are guaranteed to pay off your loan the fastest and save the most interest. It's simple, and it's something you should definitely do if you have a paid off loan.